The labor market is extremely tight and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by a half percentage point and anticipates that ongoing increases in the target rate for the federal funds rate will be appropriate.
So we just saw Jerome Powell mentioning that the Fed is going to raise interest rates a number of times during 2022. And the reason they have to do this is to get inflation under control, because that's been rising quite rapidly over the past year. So this is why they're talking about making a number of rate rises in 2022. And the federal funds rate basically dictates the interest rate which banks can lend and borrow money from each other. And this will then filter down into the general economy, into businesses and individuals when they're looking to try and borrow money. So essentially, by raising interest rates, it's going to make borrowing more expensive. And we'll also look at some basics of inflation later on in the video. And in most circumstances, when you're seeing the interest rates go up, it's because the central banks, of which the Federal Reserve is one, is actually trying to slow the economy down because it might be getting a bit overheated. And raising interest rates is one of the tools they've got to actually do this. But what do rising interest rates actually mean for your average consumer? So the most obvious effect this has on us is that we're going to pay more money in interest when we're looking to take loans or credit out from a bank or another lender. So if you think of things like big ticket items, perhaps like you need a mortgage for a house, or you need a personal loan, credit cards or student loans, each of these things is going to get affected by the interest rates. And obviously any loan, you're looking to try and get the lowest interest rate you possibly can. So in terms of mortgages, if you're on a variable rate mortgage, you're going to see the interest rate payments go up for that, meaning you're going to have to pay more for your mortgage each month. And it's also going to make it difficult for any new buyers to get on the property ladder, which has been a big problem in the UK before anyway. So if you think that you're going to have to pay more, it's going to be more difficult for you to do that. And obviously with deposits being quite high, that's going to be a financial challenge. The same thing will apply to auto loans or car finance. Existing loans you have will probably be fine because they're going to be on a fixed rate. But if you're looking to take out a new loan, you're going to find that this is going to be more expensive. So in this case, it might make you think again about buying that new car or even the second-hand car if you require finance for it. A similar thing you'll see in credit cards as well. This is going to mean an increase in the APR of the credit card. And you might also see the minimum payment amount increase as well. But I'd recommend never to hold any balance on your credit card. As soon as you pay for something on your credit card, just get it paid off straight away so you're not going to have to pay the interest on it. I have made a previous video before on the benefits of credit cards, so I'll leave a link for that below in the description as well. And perhaps you also need a loan to start a business. So this is going to make that more difficult for you to do because you're going to be paying much higher rates. And obviously any higher interest rates are going to eat up into your profits. The same can be said if you're looking to expand an existing business you have. Perhaps you're looking to open a new coffee shop. You've got one already, but that might make you think twice about opening another one. Obviously, one place you might benefit from higher interest rates is in your savings account in the bank. But this isn't really likely to help you that much in a high inflation environment, which is what we're seeing right now. And you can see in the examples I've mentioned that basically it's trying to make borrowing more difficult. So it's trying to discourage people from borrowing, which has the effect to slow the economy down. And companies in the stock market will have similar issues to those of individuals. They take out loans to try and grow the business faster. They also quite often need to refinance their existing loans. So they're just trying to tie their old debt into new debt at better interest rates, which has been possible in the recent environment because the interest rates have been low. But now this is not going to be possible. So they might have to pay higher rates going forward. And obviously everything that involves paying higher rates is going to eat up into the profits of the company because they're going to be paying higher interest. And you see what normally happens when profits go down and investors start to panic. They think, okay, this business is not running as well as it could. So then the institutional investors start to move their money out of one particular company and look for alternative places to park their money, either in another company that's still profitable or in a completely different asset class. And at the same time, they've got the interest rates rising. The inflation is also hitting the companies really hard. And also a lot of these businesses are going to see the cost of their raw materials going up as well. You might also find that your employees are demanding higher wages to kind of keep up with the general increases in the cost of living. So then you're paying them higher wages, and all of this will eat up into the profits of the company. And it's no real coincidence that since the global financial crisis and the market bottomed out in 2009, we've been at almost zero interest rates for 6 years, and the interest was less than 0.25%. And these really low interest rates have allowed businesses to grow really rapidly. And Warren Buffett mentions that interest rates are like gravity in valuations. If interest rates are nothing, values can be almost infinite. If interest rates are extremely high, then that's a huge gravitational pull on values. And these points illustrate how much impact interest rates have on growth and spending. And now we'll just take a quick look at inflation, which is obviously the reason why the interest rates are going up in the first place. So first, we're just going to take a quick look at the definition of inflation. Inflation is the decline in purchasing power of a given currency over time. And this means that your money will buy less tomorrow than it can today. So this is why you'll have your parents or grandparents will kind of go back to their memories of when they were able to buy a beer in a pub for 50p a pint. That was probably in the early 1980s, but you kind of get the idea, even though they won't mention that it's generally relative because their wages were a lot lower at the time as well. And a small amount of inflation is not necessarily a bad thing to keep productivity and growth in the economy. The US targets an annual inflation rate of around 2%. But what we've been seeing over recent months is way above that. And we can see in this chart that the latest inflation actually hit 8.6%, which is the highest it's been for 40 years. And there's a lot of factors which play into the inflationary environment. But generally speaking, inflation is caused by an excess demand for goods and services. It could be that there's rising demand for goods and services and the production of those goods and services isn't able to increase at the same rate. So this creates an excess demand there. And what that does is it makes people prepared to pay more money to get the same product. Because there's less product available, if the people really want it, they're going to be prepared to pay more money for it. And this is something known as demand pull inflation. And another type of inflation is cost push inflation. And this is something that happens when the cost of producing goods and services increases. And in order to stay in business, they need to pass these extra costs on to the consumer. We've seen large increases in the price of lumber, which is required for home building. You could also be looking at a shortage of wheat. That's going to be a huge issue coming out of the war in Ukraine because they supply a lot of wheat to countries in the Middle East and Africa. And wheat is required for products like flour, for making bread, and also cereals. And central banks like the Federal Reserve and the Bank of England really have a great balancing act to perform here. They need to maintain high employment and growth within the economy. But now they're in a really tricky situation due to the inflationary pressure. They know they need to put the brakes on the economy by significantly increasing the interest rates. But obviously the flip side of this is it risks pushing the economy into a deep recession. And obviously there's going to be unemployment which goes hand in hand with that recession. And it helps to think about spending on an individual level before you start to scale it up to a whole population of people. So if as an individual, interest payments on your debts such as loans, mortgages, credit cards, if they increase, obviously you're obliged to actually pay that higher interest. And that's something you're going to have to do. So you're going to need to cut back in other areas of your spending in order to survive. And this leads to a decline in consumer wealth. So of course, if you've got less money to spend, the first thing you're going to cut back on is those discretionary items. So in this sense, you might stop eating out at restaurants so much. Perhaps you won't take that trip to the cinema. You might cut back on memberships such as the gym or even streaming services like Netflix. You now probably won't take that expensive holiday. So cruise lines, airlines, other travel companies are going to get affected by this as well. So there I'm talking about individual spending. But if you're a country of tens or hundreds of millions of people, this is going to have a real impact on the overall economy. So I'm not spending money on travel like a lot of other people. So these travel companies, they're going to have less money to spend. Maybe they have to let staff go. And then those staff in turn, they're not going to have money to spend. And this kind of goes like a big spiral in the economy, making the spending in every area go down. And even the people who keep their jobs, perhaps they lose confidence in the economy and whether they're going to keep their job. So they will hold on to their savings, try and cut back on all spending that's not essential. And then suddenly the economy is kind of grinding to a halt. And if you have a spare half an hour, I'd highly recommend going over to Ray Dalio's YouTube channel. He's got a great video on how the economic machine works, and I'll leave a link to that as well in the description so you can check it out. So we've just seen a broad overview of how increasing interest rates will affect us as consumers and how this can also impact the overall economy. We can look back in history to try and get an idea of how this has played out. For example, in the 1970s, there was an oil crisis, and this caused huge inflation in the US. And actually, in the early 1980s, they had to raise the interest rates to above 20%, which essentially totally crashed the market. They're approaching this scenario with a lot more caution. But the thing is, their rates are still relatively low, and inflation is kind of rising quite fast. So the question is going to be, are they raising the rates by enough and fast enough to actually curb the inflation? And they're in a bit of a lose-lose situation here, to be honest, but I'm interested to know what you've got to say about that, so please leave it in the comments below. So that's it for the video. I hope you enjoyed it. If you did, please give us a like. Also consider subscribing to the channel as well if you haven't already, and you can click the notification bell to get notified of when I release new videos. So thanks for watching, and I'll see you in the next video. Cheers.